Eli Lilly is up 48% this year, 430% in the last 5 years. They pay a small dividend, so that doesn't even include their dividend. Let's check it out. In this video, guys, there's something for beginners, there's something for more advanced. We cover the whole gambit. We're going to go over the overall metrics of the company. We're going to go over the 8 pillars. We're going to go over the bull and bear cases. We're going to cover the analyst estimates, and then we're going to finish it with what price to pay for this company based on our assumptions about the future. We want you to learn from us on how we analyze investments. The goal here is to teach a process. And in that process, if you take that process, you'll be able to apply it to anything in the investment world, no matter what it is, and it'll give you the ability to be a better investor, independent of everybody else. We're not here just to hand you a stock to buy. That's not the right way to do it. We will disclose if we own a company. I don't own any Eli Lilly. Mo, do you?
No.
Okay, so let's check out Eli Lilly. First off, $486 billion market cap. If you'd asked me to guess what Eli Lilly's market cap is, I wouldn't have even guessed $100 billion.
Me either.
That means if you want to buy every single share of the company out there, it's going to cost you $486 billion. All right, they did $30 billion in revenue last year and $6.5 billion in profit. In their last 5 years, they've averaged 6.34. So very consistent profit level. Now, here's a concern I have of Eli Lilly. Mo, check this out. Last year's free cash flow is only $3.2 billion versus $6.5 billion net income. And the last 5-year average is $4.24 billion in free cash flow versus $6.34. Guys, for me to explain that to you, earnings, net income, has a lot of rules attached to it. SEC, GAAP, all these different mumbo jumbo rules based on industry, etc. Cash flow is a lot more consistent, but I don't like it when I see cash flow that much lower than net income over the last year and 5 years. Yeah, in fact, a lot of investors won't even invest in a company unless the free cash flow is at least 80% of the net income. So this is already a red flag for me going forward. Okay. Now, some positives here, 78% gross margin. That means for every extra dollar they sell, 78 cents goes to the bottom line before taxes. That's incredible. But it's a pharmaceutical business. So what does it really cost to make the drug once it's already developed?
Yeah, it's all the R&D.
It's all the R&D. And that's why they're able to show a bottom line profit of 22% in the last year and 24% overall. A lot of marketing in there. Now, look at this PE, 75. 5-year PE, 76. So it already has the inklings of a little bit maybe overpriced. But again, we have to merge together the story and the numbers together to look at this company, okay? Any company. As I told you guys before, 0.8% dividend yield, which is $3.8 billion paid. Hello. How do they afford that? Guys, dividends aren't a for sure thing. You want to compare the dividend to the free cash flow. And if you look up here, last year they generated $3.2 billion in free cash flow, and they paid out $3.8 billion in dividends.
So
how do they afford that?
Prior to 2019,
yep,
they were never able to quite afford that unless they paid out all their free cash flow and then some extra. But 2020, they did $4.9 billion in free cash flow, 4.84 in 2021, then 4.95 in 2022. Now they're back to 3.21. So maybe they're banking on, I don't know what they're banking on. This seems unaffordable.
This is tough.
This is tough.
Very high return on invested capital, though.
Give them the benefit of the doubt.
But yeah, but at the end of the day, guys, money in, money out. I mean, if only 3.2 billion came in last year and 3.8 was paid, you can only do one of two things to pay for that: issue more shares or take on debt, both of which are not great for investors.
Yeah.
Okay, so let's check out the 8 pillars on the company. Oh boy. Guys, remember, if you have our software, you can customize up to 12 pillars and 4 quadrillion different variations, and more on that in a little bit. But look, 5 X's here. They got a good ROIC, which is pretty useless when you're not really increasing it. They've bought back shares, which seems pretty dumb because it's 75 times earnings. Mm-hmm. I don't really like this very much. Revenue's gone up, but free cash flow is down slightly, and net income is down a lot. Oh boy, 76 times 5-year earnings, 115 times. Guys, these metrics are understandable if you're a small growing company or just pumping a lot of money into the business, growing that earnings and revenue and everything. But they're a $500 billion market cap.
Yeah.
They're a $30 billion. Look at this, Mo. 16.5 price to sales ratio. Guys, Microsoft, which you think is overpriced, is like 12 times sales. This is 16 and a half times sales. And Microsoft has a much higher growth rate on its earnings per share than these guys do. Oh boy. Mo, do you have some bull and bear cases on Eli Lilly? Because remember, when it comes to pharmaceutical guys, what's most important is the pipeline. Because they take a drug, they get the patent for, I don't know, it's 17 or 20 years, and they got to really take advantage of that. Because once it goes generic, their revenue is going to plummet. So it's all about keeping that pipeline of drugs in and flowing. And even if they have a big pipeline, it's important that the pipeline is a marketable pipeline. So they might have 50 drugs ready to go, but if only one of them can really make decent money, it's 49 useless drugs.
Yeah. So they're really riding a wave. Like, look at this price action right now. Look where they were just in March. In 306. March, they were 306. Today they're 540. So they're really
up 50% since March.
They're riding this wave of this donanemab. This is the Alzheimer's drug that they've been approved. They're in phase 3 right now. They're showing that there's a 40% less decline in patients that are taking it. So that's great. But Alzheimer's is a very tricky area to study. They've been acquiring companies they just went through another acquisition today. They acquired,
today?
Yeah, so I just looked this up. They acquired a company called Sigilon. So Sigilon's main thing that they are doing right now is the same thing as Wegovy.
Okay.
The weight loss stuff.
Yeah.
So that's obviously a very big area, but there's a lot of competition in that space right
Especially now it's starting to heat up for the competition because of how popular Ozempic, Wegovy, and the other drugs have been.
Yep. So they do have a lot of good stuff in their pipeline, but those are the main, let's see how much they have in their pipeline. How many drugs in total? Phase
Not that
3.
many.
No, not as many as I thought. Let's see their phase 3. 1, 2, 3, 4, 5, 6, 9, 12. Wow.
Oh, actually,
15.
it's like 18, 21, 23.
23 in phase 3. That's a big deal. That's a big deal.
Because the percentage of like phase 3s that make it are like 55 or 60%.
Yeah.
Now the question is, are they marketable drugs? Like, are they ones that can really generate a lot of revenue and profit for the company?
So looking at, this is their stuff that's in regulatory review. I would say yes, revenue driver. Yes.
So cancer,
yes.
yeah.
This one I don't know.
So Zepatide?
We don't know about the Alzheimer's stuff.
The Alzheimer's thing could be a big one.
It could be a big one, but could also be a big flop.
Yeah, it's true.
Because Alzheimer's is just a difficult disease to study.
So it's a lot of speculation here on these pharmaceutical companies. That's why I personally stay away from pharmaceutical, because I don't want to have to stay up on their, hey, what are they doing? What are they in phase 1, 2, 3, et cetera. My father's a physician. Most fathers are a physician. We do talk to them about drugs here and there, but I just stay away from it myself. Mo, I know, likes pharmaceuticals. To each their own. So let's go to analyst estimates.
Wait till you see this.
Oh my gosh.
Yeah.
They're expected to make $8.79 a share, $21.47 in 4 years, according to the analysts. So there's a lot of analysts there. 12 analysts, Mo.
What is the bet here? What is going on?
So they see something we don't see.
Have to.
These are big jumps, guys. So they probably think some of these drugs in the pipeline are going to be major, major revenue growth. But guess what? Even at $21.50, they're currently at $540 a share. If they were to make 4 years from now, $21.50, what is that? That is 25 times. That's 25 PE for 5 years from now, 4 years from now. I don't know. Seems kind of difficult. Remember, every investment's the present value of all these future cash flows. I don't know. Let's look at the revenue growth estimates according to analysts. From $31 billion this year to $53 billion. Boy.
A big difference.
Big difference, Mo. We're talking about mid double digits versus these low, like 20, 30% growth in earnings per share. All right, so this is what's going to make the stock analyzer tool more fun, because we're going to have a wide range here. We're going to put in low estimates. Let's say they don't really do what they want to do. High estimates, they crush it. But remember, on our software, the software was created to make life easier for Mo and I. It has helped thousands of people become a lot more sane about their investing, a lot calmer, because it merges the numbers part to all the stories that go out there. That's what's important here. All of these tools are created to make life easier for you as an investor, to take what's in your head and translate it to numbers. So if you like this, go to everythingmoney.com, sign up. It's about $1 a day. It's a no-brainer, guys. It'll sit there and help make your life easier. It gives you the community chat with thousands of investors, all these tools. Go check it out now. Mo, Let's do our low, middle, and high assumptions on revenue growth for the next 10 years for Eli Lilly.
I want to start at 6, 10, and 14, but I'm wondering if that's too high.
I think that's too high.
I think so.
I think 4.
I think 4, 8, and 12, maybe?
Yep, perfect. I think that's great.
Yeah.
Okay, profit margin.
All right. 19, 22, and 25?
Okay, that sounds good. Now, guys, I want you to know, Mo, I would actually argue it's probably going to be higher than 25 if they crush it.
Then why don't we put higher than 25 on the, because
I'm still going to keep the 19 and 22. I'm going to go to 30.
Okay, I like that.
Now, guys, remember, we have to look at the 5, 10-year numbers, but for drug companies, if they crush it and they get that $21 per share, that profit margin is going to be really big. Same with free cash flow. So free cash flow, Mo, even though it's always been lower, what are you going to do here for free cash flow?
I don't think I'm going to make it the same. I
don't think so either.
Lower. What about 13, 16, and 19?
So let's do this. Let's do 13, 16, and 23.
Right.
Because if they crush it on 30, they're probably going to crush it on their free cash flow.
Correct.
Now, PE, guys. Guys, don't be the sucker who looks at this PE and goes, oh, well, 75, so therefore 50 is a discount. No. What we recommend people do is the market average is 15. You go higher if the revenue growth, return on invested capital, and the moat are very high. You go lower than 15 if it's lower, if those 3 metrics are bad. So Mo, what do you do here?
I think I'm going to go like 15, 17, and 20.
I actually want to do like 13, 16, and 19.
Oh, okay.
Because I think to myself, if they don't do well, Mo, it's going to be an ugly situation.
Okay.
Because think about it. If these drugs don't make it, what's Eli Lilly going to be looking at?
Yeah.
If they don't hit what they're supposed to hit.
You did 13, 15?
13, 16, and 19.
16. What, do you want to go higher on the high end?
No, I think I'm fine with 19.
Okay. All right.
Now, what about desired return? This is our margin of safety, guys. You guys can get a 9 or 10% return from investing in the market. So for this, you want to have some sort of margin of safety. And I think with drug companies, the margin of safety has to be there because there's a lot of risk involved with patents and developing new drugs, et cetera. And guys, this is all part of the subjective part. This is the art of investing. There's no right or wrong answer. It's about coming up with a story and attaching numbers to that story.
I think I'm going to go 11, 13, and 16 on the high end.
I like that. So he's doing a little bit better than the market return, but going higher as we make higher assumptions. So guys, we're going to hit the analyze button. I imagine this is going to be ugly.
Yeah.
But I need you to do me a favor. Stay with us to the end of the video. Don't just drop off. I'm going to explain these numbers to you very quickly. There's only about a minute left in the video, so please watch us. Oh my gosh. I got a low price of 56 to 83, a high price of 160 to 205, a middle price of 90 to 120. Guys, basically if you buy today, even if the best numbers occur, you're barely making money. The key here is, that's why we love our stock analyzer tool. It helps tell you how overpriced it could be. So for them to even justify today's price, they absolutely have to kill it. And for me, that's hard. So I'm out. But again, you might know something better than I do. So sign up at everythingmoney.com for our software. It'll help make you a better investor. Take care.